What's up? What's up? It's a live premiere of What Are Your Thoughts? Probably the best investing show on YouTube. There are some other ones that I like, but I really like this one. Not only do I like making it, I like watching it later and saying, like, here's all the stuff I should have said that I forgot in the moment. But that's the challenge. I'm here with Michael Batnick, as always. Michael, say hello to the folks.
Hello, hello.
Michael's very excited, as you guys can say. Josh Brannon is here. Part-time Larry. Pat Lewis, what's happening? Cliff Peebles. Brian Gill. All the regulars. We love that you guys are coming for the live premiere. Really means a lot. Makes the show a lot of fun. And we are checking the stream. So if you say something funny, don't be shocked if you see it posted up here. Duncan is here. He's got viewer topics. Duncan just got married this weekend. He's got bags under his eyes. Looks like a lot of parties. A lot of late nights. Super happy for him. John is here. We got a lot to talk about. Before we do, I want to thank you guys for checking out the Compound and Friends. The videos, the podcast last week went crazy. The downloads are still going crazy. Michael posted a clip on Twitter. How many people watched that? How many views did that get?
100,000. I've never seen such a thing. JC. It's all JC. Credit to JC. Guy's a
JC's
maniac.
crazy.
Maniac.
It's our boy. All right. So we appreciate you guys coming through. We're gonna get right into the show. Before we do, quick shout out to YCharts, best sponsor in the world. You guys know how much we love YCharts. We use it all the time. You're gonna see charts during the course of the show that we think are important or interesting, and we made them for the most part using YCharts. Lots of data too. All right, number one, Q3 earnings season is upon us. And I normally don't pay that close attention to the estimates going up or down going into an earnings season. But this one I am, because I think it's going to be the strangest earnings season in a very, very long time, and potentially could have big consequences for the direction of the market into year end. First things first, Michael, what are your thoughts about this coming earnings season before we do the numbers?
I'll tell you first. Well, first things first. Get on Quarter if you're getting ready for earnings season's app.
Okay.
That's my
we're
first
already
thought.
we're already promoting shit.
Already. All right. Listen, it's a good tool. All right. My thought is, well, we got JP Morgan in the morning.
JP
American
Morgan,
Airlines?
yeah.
What else we got?
JP Morgan is the first. And then, but wait, is that this week or next week?
No, I think we've got BlackRock, Delta, JP Morgan.
Yeah, JP Morgan is the same day as Morgan Stanley and Citi.
I'm going to guess
Then you
BlackRock.
get Goldman.
They sold some ETFs this quarter. I'm guessing we're going to hear some of that. This is
get,
going to be weird. This is going to be.
You get Bank of America at the end of the week. Yeah. Those are all supposed to be good, though.
Well, rates have been rising, so I don't know what the lag is, but that should be good.
No. Listen, don't worry. The banks, honestly, the banks are up 10% over the last 2 weeks versus the S&P up 1%. Don't worry about bank earnings. It's actually a blessing that they're kicking us off. It's been record-setting, the amount of just equity issuance, bond trading, stock trading, IPOs, syndicate business, all kinds of private lending. It's going nuts.
So
maybe an all-time record low. Sorry, maybe an all-time record low in defaults. It's like illegal. So I think the banks are going to be very, very strong. Fortunately, they start us off.
All right, let me sound cliche for a minute. Forgive me. I am very interested to see the investor reactions to what it will ostensibly be good news for the stocks, for the companies. Because banks are the strongest area of the market right now. Banks and energy stocks.
That's right. So what's interesting about banks and energy stocks are going to have the biggest growth over this quarter last year. That's why you're seeing a lot of people pile into those stocks, in addition to the fact that crude is going up. I want to read something. I pulled this from Axios. Third quarter median earnings per share in the S&P 500 expected to reach $48.32 a share. That's an 8.3% decline from the second quarter.
That's a weird metric. I don't know. That's a weird metric. Is that one that's cited often? The median company? That's a weird thing.
Well, let's do it this way. We think that earnings growth over Q3 last year will be 24.5%, which is really, really good. The problem is it's versus like an 80-something% number in Q2. versus
Do you think
last
investors
year.
are
So
that
it's
dumb?
decelerating.
The market is not that dumb where it's going to say, yeah, 24 is good, but it's not 90. I mean, no shit, the 90 is not sustainable. I think everybody knows that.
Well, there's a couple of things going on here. Typically, companies beat Wall Street earnings estimates by 3 to 4% in a normal quarter. But in Q1 and Q2, this is coming from Nick Colas at DataTrek. In Q1 and Q2 of this year, the beat rates were 23% in Q1 and 17% in Q2. And he says that's why we're up 17% year to date. Those beat rates are fucking crazy relative to what we normally see. And that goes a long way toward explaining. So he thinks we need a 10% beat rate this quarter, or we've probably seen the highs for the year, which might be a little bit too dour, but he basically thinks we need to beat these estimates by a lot. We have these charts. Go ahead.
What's going to be important, I think, going forward is forward guidance. What are companies saying about the fourth quarter? And you know what? If the top is in for the year, I'm okay with that. We're up. What are we up? The S&P is up 17% this year. I'm fine with that. It was up 18% last year, 31% the year before. I'm fine with that. More than fine.
Savita Subramanian's talking about a big uptick in companies complaining about forward-looking conditions. So let's put these up. John, roll the first chart. Chart on. Sorry. This is the forward estimate. So Michael put this together via Y charts, and basically you can see that little dip. This is for the next quarter, but we're still going to be reporting record high earnings, give or take. Next chart. Profit warnings. This is the third highest number of profit warnings in terms of Bloomberg story counts. So you're basically looking at the number of stories being published with the word profit warning. And last chart.
This is a good one.
So like even the companies that are beating, they're not really getting much of a benefit. Like there's not a lot of alpha for owning a stock that beats earnings right now.
But wait,
and
hold on,
obviously
Josh,
that
Josh.
oscillates.
This ended in what? Q2?
This is as of the end of it looks like
Q1. So this
Yeah.
is very stale.
Well, the point is the direction, right? So there's less and less reward for companies beating earnings relative to what there used to be, but companies missing earnings are getting hit pretty hard. So
I mean, I don't
it's
know. I don't know what the median stock is or the average stock is relative to its 2020 high in say February, but given
Down.
that so many, no, I don't think so.
Well, relative to 2020, not 2021.
So
Okay.
given that so many stocks, forget about the bottom, are still 10, 15, 20, 30% higher than their peak in February 2020, yeah, the bar's high. That's okay. Stocks have done extraordinarily well.
The bar is high and the complaints are loud. And that's why people are concerned about guidance going forward. Like you're really hearing a lot of concern about hiring people, and you're hearing a lot of concern about supply chain. And yes, the consumer is ridiculously strong, but like that's in the market, and will it offset enough? So that's the concern. Listen, it's a very weird year, and a lot of the prior periods where you had a weak Q3 maybe don't apply because of all the different cross currents going on here. But I do think if you combine a lackluster earnings season, if that's what ends up happening, with softening guidance and a Fed that seems to want to taper and higher taxes coming, like that's an ugly It's an ugly picture. Just throwing it out. All right, what do you got?
Well, hold on. Before we move
Now
on
that
to
I
the
brought
topic-
everybody down,
Yeah,
what
geez.
do you got?
But let me bring you back. Before we move, see, I'm the glass half full guy. Before we move off this topic, throw up that valuation chart.
I like this,
All right,
actually.
This is from...
Tell people, explain this to everybody.
I'm about to. This is from Urian Timmer. I'm guessing that's a silent J, right? It's not Jurian. It's got to be Urian.
I believe it's Korean.
At Timmer Fidelity. It's a director of global macro. He's a great follow on Twitter. Okay. The top chart is obviously showing the S&P 500, right? There it is. The bottom chart is showing the forward earnings, the forward PE. And so we've come down. So if you're a value oriented type of investor, this is a good thing.
How does
and
this
you
happen?
notice-
Because earnings
you
are going
notice-
up and stocks are not.
Earnings
Okay.
estimates are going up. So you notice that stocks have really gone sideways, treaded water, while estimates keep rising. That's a good thing in a vacuum.
Got a couple of questions on this stream really quickly. Shakespeare asked where Michael got that Trends T-shirt. We made it. It was a collab between us and StockTwits. I think they're all sold out now. Yep.
Oh, look at that. It's got a logo on the back. I didn't know that.
Joel Dunlop says it would be strange for Labor Day to be the top for the year, but it's a strange year. Let me actually you. Labor Day was literally the top in 1929. No relationship beyond that, but that's actually
Yeah,
a
that
true
is
story.
a knowledge drop.
I know.
right there.
I'm
Good
just,
for
but
you.
I'm just. I gotta just say that.
Although, according to
I gotta just say
JC, the market topped in February.
that. Enthusiasm.
And pessimism bottomed last week, as we learned. Okay, let's talk about. We're going to stick with another Urian Timmer chart. Let's go chart on, boys.
Why don't you just marry him?
I would.
Oh, this is a good one. This is a good one.
This is
too.
interesting. He said, sign of the times. It took a 102% gain from the low for investors to buy equity funds and ETFs. This remains the most unloved bull market that I can remember, at least from the perspective of traditional fund investors. And to me, leave this chart on for a second. His last point, from the perspective of traditional fund investors, is the key phrase here. So before we go chart off on top, what we're seeing is the bull market, bear market returns, the percentages, right? So we're up 102% from the lows. And on the bottom, you see a rolling 12-month inflow outflows into equity mutual funds and ETFs. And as you saw, last year, shit got real ugly. People were real nervous, understandably so. Okay, let's go chart off. This is what's interesting about this market. And Ben said this market makes no sense because you have data that could support whatever conclusion, whatever story you're trying to paint. This you could find it very easily in the data. Traditional fund investors, demographics control a lot of this. Economic has been pounding the drum that demographics suggest that equity funds are going to keep seeing outflows. Bond funds are going to keep seeing inflows because the people that control the wealth, that's what they're doing with their portfolio. On the other hand of the barbell, you've got Robinhood and SPACs, which I guess died, memes, NFTs, people going crazy. So maybe this is just a really good look at the people that are buying and selling traditional mutual funds. Your turn.
What's so great is that it really is a changing of the guard generationally. And like the media has had a lot of trouble scaring investors over the last 15, 16 months.
Which
Because they
investors?
have so little young investors who are
Can't
taking
do it.
over.
Can't scare them.
They have so little at stake. It doesn't matter. It's like exciting almost. It's almost like Squid Game for them. But nobody's getting shot. They're just like getting buying opportunities. So if you think about who's taking over this market, looking at mutual fund flows, there's no relevance. Those people are going away forever who are liquidating mutual funds. They're coming out of retirement accounts.
Those flows are one
What's
direction.
dominating trade right now.
Those
I think
fund
that's a really good
flows.
point.
Those fund flows don't say anything about the state of the market because I think those are secular.
You know what's funny? I used to look at the Merrill Lynch fund flows. I think they called it the flow show or whatever. I mean, it's interesting, but it's like representative of Merrill Lynch clients. They're looking at their own data. That's no longer representative of America.
I'm more
I don't
interested in flows into and out of individual stocks. VandaTrack is the company that publishes great data on that. That to me is interesting.
Wait, it's not enough to just look at the stock prices rising and falling? You want to see the market cap increase?
No.
don't
I
understand.
want to see retail flows.
Oh, like trading flow. Like, can't you just look at trading volume, or you need
So
something, you need something additionally?
For example, today, the biggest. Oh, this is interesting. And we're about to talk about this later. This is a coincidence. Holy shit! This is not on my radar. I guess I've been snoozing. The biggest inflows that we saw today, at the retail level, Verizon and AT&T. They are buying the crash. Look at these charts.
These are the worst stocks.
Holy cow! We'll come back to this in a second. Let's go next.
Good yields,
topic.
though. Good yields,
well,
though. All right.
we'll come back to that.
Fake it till you make it. It was cute, like a few years ago, I think, but now it's become an epidemic, not a pandemic, but like now this mentality is everywhere. I think there's a new generation of young entrepreneurs raising money, and their model is not Jeff Bezos and it's not Steve Jobs. Their model is Elon. And Elon became the richest man in the world basically by daring people to call his bluff and being able to raise money at will, so that even things that he was making up on the spot, he would be able to buy himself enough time to either misdirect everybody or actually hit the milestone, even if he hit it late. And it worked. And that would not have worked in different environments. So Galloway, I thought, did a really good job of explaining this in New York Magazine. And I just want to read a piece of his quote, and then I want to ask you what your thoughts are. This is Scott. If a journalist had gone after the wealthiest men in the world, Jeff Bezos and Elon Musk, early on, and said, you're in a cash crunch and about to go out of business, which was certainly true of Tesla, and Amazon had some rough years, it could have put those companies in downward spirals that they might not have recovered from. They would have gone from Edison and Ford of our generation to the Elizabeth Holmes of our generation. Sometimes the line between vision and alleged fraud is getting your next round of capital. Too far? What do you think about that?
No, not too far. Not too far.
Really, really obvious, right?
He said there are 50,000 shades of gray when you're talking about the differences between being a visionary or a fraud. This works until it doesn't.
There's no way to draw the line because you don't know what's going to happen.
But I've dealt with this countless times working with different fintech companies that overpromise, and it's like, come on, what you're saying, you're not even close to ready. You're telling me one thing, I'm using your product. What you're saying sounds great, but the product's not there.
But they're raising money from investors as though it is there.
So, but this is the entire.
And then we're like the buyers of the products, and we know it's not there.
This is the entire thing, and again, we've dealt with this countless times with various companies. Actually, to a T, I feel like almost everybody overpromises.
Do you agree with this? If Elizabeth Holmes had managed to raise another $500 million, and Theranos had shown some progress with the Edison, their blood testing machine, I wonder if she would have given the commencement address at Stanford last spring.
100%.
Her defense lawyers are basically saying she's not doing anything these other guys haven't done.
So faking until you make it is great for raising money.
But she's like a liar. But she's like a criminal, though.
She's different. But it sucks for your users. And I don't care if you tell me that your product is not going to be ready for 3 months. Don't lie to me. Like you're gonna. So I forget who said this.
Is this different? Wait, is this different than like how Uber did it? They weren't faking it. They really were doing it, but like it was against the law, and they were just like, well, we're just going to keep doing this until they change the law. Is that the same family, or is that different?
No.
Okay, that's different.
Uber was just disregarding all the rules, but they were at least doing what their product said it was going to do.
Okay, so these are people that, all right, the reason this came up is these assholes at Ozzy Media, which was a complete fraud. They were raising money from Goldman Sachs and other media people. And by the way, they had a great story. They're like ethnic minorities, and they're in media, and they had like great traffic numbers, which turned out to not be real. And like everybody like wants to be woke, and nobody wants to be like, what do you mean you didn't write the check? So everybody's giving these guys money, and they're basically lying their asses off. But to the earlier point, like if they could have kept this thing going before getting caught in an obvious lie by pretending to have somebody from YouTube on a conference call, let's say they never got caught doing that, they probably could have kept faking it until they built enough traffic that was real that they could have been like a going concern. Do you think that's true?
Yes, I do. If you shrink the
that's
gap,
why they're doing this.
If you, I understand why they do it. I mean, it's clear. But if you shrink the gap between expectations of a client or customer versus the reality that you can deliver, you will have happy customers, right?
Even if you can't do it in the exact amount of time you promised.
Even if the expectations are, hey, this is going to take time, versus like, just tell me the truth. I hate being bullshitted. It's like my biggest pet peeve.
Let me ask you this question. Let's say, Michael, you're doing a lot of private investments these days, killing it. Let's say you invest in something that ends up working out. You get a 10x return. And then the CEO comes back to you and he's like, by the way, I totally bullshitted you before you wrote that first check. Now, you still made the money. Are you pissed off? Do you feel wronged?
Yeah, I
would. You don't. You're lying. You're like, oh, wow. Glad it worked out, though.
Listen, I don't know how I would feel in that scenario. Ask me when that
Giving the money back? You giving the money back?
No, of course not. Ask me when that happens. I don't like being lied to. I
right.
really don't like
So-
being lied to.
So can I tell you something? I honestly believe we now have a generation of entrepreneurs. I'm not saying they're bad people. I'm saying they just think that's how it's done. And when this turns,
I don't buy that. I don't buy
When?
that. That's an excuse. Like we didn't know smoking was bad for you. I don't buy that for a second.
what don't
People-
you buy?
That this is just the way it's done. People know right from wrong. You know if you're lying.
No, they think this is right. You're missing what I'm saying. They think this is the way.
I don't
They're
believe
like,
it.
well, if I don't do this, then I'll never create jobs and I'll never launch product and I'll never get enough funding to
All right, listen,
make my
I'm-
dream
I'm
happen
sympathetic
for
to
the
that.
world.
I'm sympathetic to that. I don't know where the line is between stretching the truth and just fucking lying. I know it's a fine line.
The good news is they're lying to their own generation at this point. The boomers are no longer making these investments.
All right.
So it's Gen Y lying to Gen Y, and there will be a lot of outright frauds in the private markets that are not being regulated really at all. And last point on this, fortunately, the big blowups of our era were not public. WeWork, Theranos, this Aussie Media piece of shit, and whatever the other two were, they never made it over the line. They never got. Nicola's the only one that like escaped the lab, so to speak, and it never got big enough to infect people in a major way. So that's like maybe one silver lining. Okay, you're up.
All right, let's move on to this. There was
This
a
is
hell of a-
worse.
No, I have a take. All right, so last week there was a story from TechCrunch. Fantasy Equity NFT game wants you to spend real money buying fake shares of real startup. And my first reaction is stop the ride. I want to get off. Top. It's enough. The next day, the Block reported, actually, NFT marketplace selling fantasy equity shuts down one day into open beta testing. But, chart off, please. As I read this, I said, you know what? Actually, I don't hate it. Here's a quote from the article. The memification of ownership and the wild acceleration of private startup valuations have led us to this moment where a former VC firm associate has built a crypto marketplace designed for fantasy startup investing where users spend real money buying fake shares in NFT form, of course, of real startups. Honestly, this is not even close to the dumbest thing I've ever heard. And I kind of think this could be fun.
I kind of think it's the dumbest thing I've ever heard.
Not even close. Get out of here.
Well,
Not
what's
even
the, all right?
close.
Let's peel back the onion. What's the point?
It's fun.
If you want to
What's the
invest,
point?
if you want to invest in these things,
You don't have access to. You can't.
hold on. An NFT game, you're using real money.
Right.
You're investing in fake shares of, so you have virtual ownership of
Yes.
things that don't trade
Correct.
because you can't
I don't
get
hate
in.
that. I don't hate that at all. I actually kind of like it. And matter of fact,
So is
matter
that
of fact,
is that the public private market?
I don't even know what this is, but guess what? They were too early. The market wasn't ready for this. This will exist. So what happened was, I think they got into like legal kerfuffle. They said for the last couple of weeks, we worried on building the minimum viable product of a game that brings
They're
this idea to
selling
life.
securities without a license.
Everyone's selling securities. However, during this process, we underestimated the legal complexities and decided it's best to hold off. Hold on, last thing. So the company's called Visionaire. They're pivoting to a free-to-play model in which the game will give players a certain amount of credits to build their startup portfolio and then compete on their portfolio's performance. I like this. Sorry, I think it's fun.
These are securities.
Okay.
Well,
What's
you
your point?
can't do that.
What's your
My
point?
point is you literally can't do that. It's illegal. We have securities laws. You can't say this is like a stock of a company, but I can't own the actual stock of the company.
What?
So it's a stock based on another stock. You can't sell securities to investors, period. You
Why
can't
are
deal
these-
in securities.
What if they're not?
I just told you why.
Why are
just
what?
told
Why
you
are
why.
these NFT securities and
It's the Howey test. It's the
crypto
Howey
codes
test. It represents an interest in a corporation that you expect to make money, that you expect it to earn money from it going up. It's a security.
guess what?
This is not even one of the. This is not even a tough one. There are really tough ones like blockchains.
Guess
this
what?
is
This-
not even that.
This will be. This will roll out. FTX will do this. Somebody will do this overseas, like tomorrow.
Here's my take. None of these things go out with a bang. They all end with a whimper. and all of the breathless reporting about now people are doing this. Yeah, they do it. And then like the next day, a few less people do it because it's pretty stupid and not that interesting. And then people that made a lot of money pull out. And then people that got killed the first time, they don't come back. And these things just like fade away. It doesn't need to go out with a bang, a blow up. People don't have to get like completely destroyed. I just think they lose interest in things that
this
are
idea.
fucking pointless, and this is fucking pointless.
No, it's not. You're pointless.
It's not an anti-NFT take. I'm just
You're
telling you.
anti-everything. You're anti-everything.
I'm really not.
Get with it.
I'm really not. Fantasy equity? Can we? Does everything have to be fake? Can we just invest in real things for like 5 seconds? All right,
I'm
gonna
getting to
move
real
on.
things in my next topic. Let's go. Next topic.
Okay, thank God. Hester Pierce. She would take the other side of me. Do you know who she is?
Yes, I do.
Okay. She's kind of a maverick. She's like a libertarian regulator or somebody that has a position of authority, but is kind of like, hey, maybe not so many rules. Let people do what they want to do. I thought this is a really interesting op-ed.
She's an SEC commissioner. How many are there?
There's a bunch, but she's like, what she's basically saying, which is not, I don't think, the majority opinion among the regulators right now. But she's saying, and there's a longer quote, but she's seeing a lot of frauds, of course, week after week, year after year. It can make a securities regulator like me wonder whether anyone raising money from investors is honest. But that cynicism can undermine our role in protecting investors. Investor protection means enforcing anti-fraud and disclosure rules, but it also means protecting an investor's right to make decisions for themselves and to take risks with the latest technology to trade and invest. And then she says, shots fired, regulators are risk averse by nature. I'm not sure if that's true. Also should avoid yeah, I guess that's their job, right?
That's like hammer
also
nail
should
type stuff.
Yeah, also should avoid imposing their own risk tolerance on investors, many of whom are comfortable with taking risks that regulators would not themselves take in choosing their own investments. That is a take. What are your thoughts?
I love that take. I think she's 100% right. I don't understand.
Are we just saying that after a 15-year bull market, though?
Stop playing games. It's not. It's a bull market. I don't understand why they're allowing the XIV piece of shit product to come back in a different wrapper. I don't understand why half the products exist that do, and some can't. Some can, some can't.
Do you think you're saying you don't understand why? Do you think she's making the argument as to why? Because the people making that decision are more risk averse than the general population?
Yes, I agree with her. I don't understand a lot of things. I went on this rant on animal spirits. How come, speaking of fantasy, how come I can use either DraftKings, I think it's DraftKings. I can use DraftKings to play daily fantasy sports and I can bet money on that. But I can't bet money on the Giants losing to the Cowboys. Where are the lines? They seem so arbitrary.
Yeah, I think that arbitrariness is just a relic of like laws that haven't been repealed yet, different states.
How come I can invest?
That'll normalize.
How come? But the DraftKings, that's new. How come I can invest in a triple levered natural gas ETF, but I can't buy a Bitcoin ETF?
Well, they'll say that there are plenty of warnings at the brokerage level for those triple levered. People are told that they're meant for short term, et cetera, and there's education around that.
Bitcoin is
and there
risky?
isn't for this yet.
What are they protecting us from?
The underlying natural gas, they understand the market, and these various blockchains, they haven't done enough research on. That's what I've been told. So I don't know if that's true. There's the famous story about Massachusetts, the state, quote, protecting its citizens from investing in Apple on the IPO. And the reason given was that Apple wasn't profitable when they were coming public in 1980 or 1982 or whenever that was. These days, like, not being profitable is a prerequisite. I'm not investing in anything that earns money as an IPO. So I guess there's always been this pendulum of like, how do we protect people without completely closing off capital formation?
Yeah, listen, I'm sensitive to investor protections and regulation and disclosures, but like just the picking and choosing, and I understand it's their job. I don't know. It's frustrating.
You know what though, Michael? You're a young man, and you've never been before Congress as the commissioner of the securities regulators answering.
Neither of you.
No, I understand, but I remember watching it on television. The head of FINRA, the head of the SEC, the head of the CFTC, sitting in front of Congress, being lambasted by 250 House of Reps people or 100 senators in a row. What the hell are you doing? And then being fodder for Jon Stewart every night. Like, there's another side to this shit. If you're going to be permissive and say anything goes, understand who is going to be the one answering for the next $1 trillion blow up. So I want to put that out there.
That is a very fair point. All right, so last week or 2 weeks ago, I can't remember, you were talking about cash flows are sexy. You collect cash flows.
I do.
You can have all the cash flows you want. Sentiment Trader said, thanks to lagging stock prices and shrinking market cap while other sectors gains, Staples' share of the S&P 500 shrank below 6% for only the second time in 30 years. So, Duncan, let's show the sector breakdown chart. So there it is.
What's in Staples?
All,
cookies, tissues,
all
Clorox.
The way at the bottom. So let's show the next chart. All right, you can't read this, so I'll read it for you. You got Procter & Gamble, Pepsi, Coca-Cola, Walmart, Mondelez, Costco, Altria, Philip Morris, Estee Lauder, Colgate, Kimberly-Clark. You know these names. These are hot. Chart off. Oh, by the way, hold on. Chart back on. Great work, gentlemen. Josh, you see that background?
Yeah, it's a supermarket.
These are consumer staples. You got the toilet paper.
John and Duncan are killing it right now.
Oh,
John's amazing.
Chef's
John's
kiss.
attention to detail is really fantastic.
Chef's kiss. So you've got all of these stocks. AT&T, which, holy moly, that thing's yielding 8%. Verizon's yielding 5%. Kraft Heinz 4.3%. Kellogg's yielding 3.7%. And I understand there's way more to investing than buying the dividend yield. But the 10-year is at 1.4%. Which would you rather own?
Yeah, what percentage of the S&P would the Staples be if they all just figured out to stop selling this stuff in supermarkets and start going direct to consumer and getting subscriptions of cookies and toothpaste? You would get a toothpaste subscription. That's what this Dollar Shave Club figured out, and they sold it for billions of dollars. What if all these consumer staples were subscription products? They arrive every month. You know you need more toilet paper. You know you need more paper towels. Cut out the middleman. Just arrive with my shit. I need it. I'm going to need it again next month, the month after. And by the way, don't call me a customer or a consumer. Call me a user or a member. What would the market cap be? Because these are some of the best subscription model businesses that don't have a subscription model that I've ever seen in my life. Procter & Gamble could be the Netflix of you smelling good. Think about this. Clorox could be the Amazon
Netflix
Web
of you
Services. Listen, Clorox could be like the Amazon Web Services of cleaning products. Like, they just haven't figured that piece out yet, and they're still fighting over supermarket shelf space. I feel like somebody in that group will break out.
Not a high-yielding stock, 2.5%. Probably raises its dividend every year for the last 1,000 years.
Buybacks.
What would you rather own? And I know it's not one versus the other, but humor me. What would you rather own, Procter & Gamble or a 10-year Treasury bond?
Procter & Gamble all day.
So you could have your pick of the litter. Yeah. They're everywhere.
That's fine.
Nobody wants them.
No, that's
it. They're yours. Nobody wants
all right.
them.
I will collect those cash flows along with this Verizon dividend. What were you going to say about that? Are we getting to that later?
What?
Verizon and AT&T?
No? Just look at those charts. My God. Verizon's yielding 5%.
Yeah.
AT&T, which is 52-week lows. My God, this looks like oh my God.
You want to laugh?
Dude, multi-year lows. It's below its 2020 low.
Go look at what they're paying these CEOs at these companies, Verizon and AT&T.
5-year low. I just keep peeling it back. How long? How garbage is it? Do I hear 10 years?
Go look what they're paying these guys, and you know what they're doing.
They're like, shit. Wow.
They're like buying Yahoo and spinning it off and changing the name. Like, these companies are like buying internet websites from the 90s.
All right, check this out.
Go ahead.
The price of the stock, and I know there's been a million dividends collected along the way, so the total return is definitely above zero. But the price of the stocks is back to where it was in 1996.
Which stock?
AT&T.
Yeah, it's atrocious. It's atrocious, and they're paying the people running these companies so much money you wouldn't believe it.
So literally,
Tom Cruise money.
a 3% return on the stock price. Now the total return is 245%. So, it's not that bad, but
Right.
just wow.
Well,
just wow.
Relative to anything else, it's pretty bad. Okay, let's bring in Duncan. He's a married man, well rested.
Yeah.
Where are you now? Are you on your honeymoon doing the show? Because I'll fire you. You better not be. You are?
I mean, kind of. I mean, we're just staying in Wilmington for the week.
All right. Are you
I
guys
can't
having
miss
fun?
What are your thoughts?
All right. We love you. The crowd loves you. Thanks so much for coming. We'll make this short and sweet. Go. What's number one?
Okay, so first up we have Victor, longtime fan and longtime person in the chat and the comment recognize
Victor.
their name. So yeah, Victor, thank you. So Victor writes, I have a 401k that's 100% invested in an S&P 500 fund and a Roth IRA that is 100% invested in QQQ. I know there's close to 50% overlap there. Is this too much overlap? Is there too much large cap here? Should I be diversifying into other market caps or just stay the course? What are your thoughts?
We don't know how big each of those accounts are?
Yeah.
No, we do. I got this.
Yeah.
Okay.
All right.
Michael, jump in.
So, in 5 names, Facebook, Amazon, Apple, Microsoft, and Google. That's 22% of the S&P. That's 40% of the NASDAQ 100. So given the dollar amounts that you provided to us, you've got 25 cents of every dollar that you've invested into these 5 companies. Now,
Wow.
you should have 100 cents of every dollar in hindsight. You should have had 100 cents of every dollar
Yeah, it worked
invested in
out
these
so
5
far.
companies. It's worked out phenomenally well. Myself, I am a fan of diversification, and I don't think you get that just in the S&P 500. I prefer market cap diversification, small, mid, large. I prefer geographic diversification, which has been brutal, but I'm still ride or die for that. So are there worse things you can do than having your money in these 2 funds? Yeah. But I think that you could do better. At least going forward. Looking backwards, you could not have done better.
Emerging market stocks are doing better this year. Some international. There's been this resurgence in commodities. Like, you don't know when the next trend is going to come, where the next trend is going to come from. It may be something other than technology. I know that's hard to picture right now. And when that happens, you're going to want to have that diversification. It's a struggle to get there when a trend like this persists for as long as it has. But is Facebook in like a 20% drawdown yet?
It's close. 17 or 18.
Yeah, so like having that massive exposure to the largest companies unchecked is not necessarily working even right now, even though it has over the last few years. All right, what's next?
Okay, next up, Greg asks, am I crazy that I don't want to pay down any debt right now when everything I have from credit lines to mortgages are 3% or less? I just keep plugging extra cash into index funds, rental properties, and some crypto. Is the smart money doing the same, or does the old school mentality of eliminate all debt reign supreme?
I want to hear from Michael on this, but I'll just say, like, some of the smartest people in personal finance who have been screaming about getting out of debt for years and years, I think are starting to change their tune. The people that responsibly are carrying some sort of debt and earning returns 3 and 4 times what their cost to carry that debt have actually done really, really well. Doesn't mean that'll always be the case, but if the present environment persists, it's hard to say that there's any urgency to pay down an easily affordable debt. Michael, what do you think about that?
I changed my thinking on this. I did a complete 180. Call it 2 years ago, I refinanced from a 30 to a 15. I got a rate of 2.8%, and I was going to make 1 extra payment a month. And I was going to pay off my house in 12 years, and I was doing backflips. I couldn't even believe the fact that by the time before my kids go to college, I will have a paid off house. And then you know what happened? Interest rates kept going lower, and I changed my mind. And I said, hey, wait a minute. Why do I need to pay off my house? I mean, I get it. I understand. But why do I need all of this equity sitting in my house earning zero, especially when the price of my home or the value of my home has gone up 20%. Why don't I tap some of that money and invest? And I might not beat that 3-4% hurdle, whatever it is, but I might. And guess what? I'm having fun doing it. So even if I don't come out ahead, it's not going to bury me. Now, you have to be careful. You have to be responsible. If your home is your only asset, I think it's a great forced savings vehicle. But with rates at 3%, if they stay this low forever, I'm never going to pay off my mortgage. I'm just going to keep doing this. Every 5 years, I'm going to take some equity out. So I don't know the future path of interest rates, but I think that if you do this responsibly, I think it can make sense. But of course, you have to be careful.
Yeah, and there's a little bit of risk tolerance in the mix too. Just
Tons.
like what would be worse for you, the downside versus the upside. Like a lot of other things.
If somebody says, it's personal. If somebody says, listen, I just want my mortgage paid off. I'll feel
that's
it.
me.
That's it.
Like my wife will not sleep nor let me sleep if we're carrying hundreds of thousands of dollars in debt, especially if we don't need to. So like we're a mortgage paid family. We always have been. It's kept my lifestyle in check. Like in hindsight, did we have to be? No, but who knew? Right. So I think that's going to be like what makes you happy, combined with how much risk do you want, combined with do you really even have a great use? For and you might not, and so why bother? So it's tough to give a black and white answer that will apply to everyone. Duncan, we're gonna let you go. I want to tell you congratulations. Please go enjoy the rest of your week.
He just ran out of here. He was quick to get it.
I was a little too.
Are you
too
fully
fast.
clothed or just for the? Listen, I want to tell you now. You have to take an extra day around Christmas time at the end of the year because I don't like you working on your honeymoon. Get out of here. Don't let me see you again. And go have a great time. Well deserved.
Thanks, guys.
Well deserved. Duncan is the best. Thank you for chiming in, my man. All right. I hope you guys had as much fun as I did, as much fun as Michael and Duncan did. We love that you come here for the premiere of What Are Your Thoughts? Come back again next Tuesday at 5:30 p.m. Eastern, or you can catch it on the replay, of course. Don't forget, tomorrow is Wednesday. In addition to earnings from some of the biggest banks in America, there's a brand new episode of Animal Spirits, my personal favorite podcast. We're doing Compound and Friends at the end of this week as well. Thank you guys for checking out all our stuff. We love you. Don't forget to subscribe. Don't forget to smash that like button. It means a lot, and we will see you next Tuesday.